Marqeta posted Q2 earnings a few weeks ago and the stock popped more than 20% the following day. Well, that's because Marqeta announced that the company has extended its partnership with its largest customer Block for another 4 years. And after reading the earnings report and listening to the earnings call, I realized there were a lot of moving parts in the new deal with Block, or Cash App for that matter. So in today's video, I will be covering Marqeta's Q2 earnings results, the Cash App renewal, as well as the implications of the new deal on Marqeta. As always, you can read the article version of this analysis and you can find the link to my article in the description box below. It is an editor's pick on Seeking Alpha, so you might want to check that out. And full disclosure, I do have a position in Marqeta, so do stick around to find out what I'll be doing with my position. And with that out of the way, let's take a look at Marqeta's Q2 earnings results. First, let's look at the growth of the company. In Q2, total processing volume, or TPV, was $54 billion, which is up 33% year over year due to growth across all major verticals, most notably in financial services, on-demand delivery, as well as powered by Marqeta customers. As you can see, growth has been slowing down over the last few quarters, but this is expected as the company gets larger in size. That said, TPV still grew 7% quarter over quarter, which is just incredible because TPV continues to grow sequentially and has never dropped quarter over quarter, so that's really great to see. As a result of TPV growth, revenue grew by $44 million or 24% year over year in Q2 to $231 million, and growth was mainly driven by revenue from Block, which increased by $52 million in Q2, offset by Klarna, which migrated a portion of its program to a competitor in Q3 last year. Revenue growth for the quarter actually beat management's guidance of about 18%, and this is also a beat on analyst estimates by $11 million. As you may have noticed, revenue growth is much slower than TPV growth, and this is due to unfavorable card program mix as well as the increasing concentration among larger customers such as Block. And by the way, Block's concentration increased 2 points from 76% in Q1 to 78% in Q2, so keep that in mind. So as a result of that higher concentration, as part of its incentive agreement with customers, Marqeta pays out higher revenue share payments to larger customers who produce higher payment volumes across Marqeta's platform. As such, revenue growth was slower than TPV growth, and this is also a major reason why take rates have been dropping over the last few quarters. As you can see right here, both revenue take rates and gross profit take rates are down year over year to just 0.43% and 0.16% respectively. Management also mentioned during the earnings call that gross profit take rate is the best proxy for Marqeta's price, but as you can see, gross profit take rate is at its lowest point at just 0.16%. Furthermore, the Cash App renewal is expected to reduce gross profit take rate from Cash App by 40%, which means additional downward pressure on take rates moving forward. This raises concerns about Marqeta's pricing power, which can be problematic in the future as it decreases Marqeta's margin profile and earnings potential. But all in all, it's still a decent quarter for Marqeta as TPV growth continues to be robust, which means that Marqeta is processing more dollars and its customers are growing as well, which is great to hear. But again, I would love to see Marqeta's take rates improve as it shows that the company has pricing leverage over customers. Turning to profitability, gross profit for the quarter was $85 million, which only grew by 8% year over year. As such, gross margins dipped to its lowest level ever at just 37%. So gross margin fell due to a 40% increase in card network fees, a 42% increase in the number of transactions, as well as unfavorable changes to its card program mix. In addition, gross margin is typically the lowest in Q2 due to incentive timing, whereby incentive packages with the card networks resets every Q2, thus lowering card network incentives for the quarter. In addition, increasing Block revenue concentration in Q2 added more pressure to gross profit growth and gross margin since Block margin is over 40 points lower than the rest of the business. Moving on, Marqeta turned adjusted EBITDA profitable once again in Q2, but that's nothing to be excited about since it was only $1 million in adjusted EBITDA, but nonetheless, it is still trending in the right direction. On the other hand, Marqeta is still very unprofitable on a GAAP basis. As you can see, net margin is still very negative at negative 25% due to a couple of one-time expenses, including a restructuring cost of $8 million and a $10 million post-combination expense related to the acquisition of Power Finance. In addition, high share-based compensation expenses is also weighing down on profitability, which was 19% of revenue in Q2. It seems to be trending downwards, but it is still very high, so I would like to see SBC drop to a more sustainable level, ideally below 10%. That said, Marqeta is still very unprofitable on a GAAP basis, and that is probably one of the main reasons why the stock is down so much. And in order to build a stronger conviction on Marqeta, I would like to see SBC continue to drop from here, as well as the company turning GAAP profitable on a consistent basis. But despite being severely unprofitable, Marqeta has a strong balance sheet with a cash position of about $1.4 billion and virtually no debt, which puts its net cash position to be about $1.4 billion. And to put that into perspective, that is almost 50% of its $3 billion market cap as of this video. But moving on, as of Q2, free cash flow was negative $26 million, which represents a free cash flow margin of negative 11%. And to make matters worse, it seems that free cash flow is getting worse and worse with each passing quarter. And as you can see, Marqeta's cash flow is still unpredictable, and that is probably one of the most frustrating things as an investor. The good news is that Marqeta doesn't seem to be burning a lot of cash at just $26 million in Q2, which is tiny compared to its net cash balance of $1.4 billion. But again, it will be nice to see free cash flow above zero consistently. Nevertheless, it seems that the company is putting its cash to good use. In particular, in Q2 alone, the company bought back 10.2 million shares for a total of $49 million at an average price of $4.75, which is lower than current prices, so that's good to see. And as of Q2, Marqeta still has $152 million available under its share repurchase program, so I expect more buybacks in the next few quarters given the fact that the stock price is still 80% below its all-time highs. But more importantly, the share buybacks help to negate the dilutive effects of high SBC, and as you can see, shares outstanding have been dropping in recent quarters, which is great to see. Now let's talk about the outlook of the business. This is the most complicated part of the earnings report, so much so that management did not provide formal guidance in its earnings report, which is the first since going public. But fortunately, management did provide guidance during the earnings call, but before we get into that, let's take a look at the Cash App renewal in more detail. So according to the company's 10Q filing, Marqeta will reduce pricing for the Cash App program, and Block will be responsible for defining and managing the Cash App program with respect to the primary card networks going forward. So previously, Marqeta manages the financial relationship between Cash App and the card networks like Visa and MasterCard, but in this new agreement, that will no longer be the case, which resulted in lower pricing, and because of the lower price, Marqeta will consequently generate lower revenue and gross profit. And because Marqeta won't be managing this relationship, fees owed to issuing banks and card networks related to Cash App volume, which is historically Marqeta's liability, will now be passed directly to Cash App, and as a result, cost of revenue will decrease as well, which leads to higher gross margins. With that being said, management provided the following Q3 guidance. Net revenue is expected to contract between 49% and 51% with an approximately mid-70s percentage point decline due to the Cash App renewal. And this is quite disturbing, and now I understand why management did not include guidance in its earnings release. I think a lot of investors would panic sell and the stock could drop by 50% because of this alone. But moving on, Q3 gross profit is expected to decline as well, but not as much as revenue at just 9% to 11%. As such, gross margin is expected to expand to the low 70s, which is significantly higher than its current gross margin of about 40%. But despite higher gross margins, it is important to note that gross profit is expected to decline, and this will lead to a decrease in adjusted EBITDA margins to about negative 12% to 14% in Q3, even factoring in a high single-digit percentage decline in adjusted operating expenses. Now that's for Q3. For full year 2023, Net revenue is expected to decline by low teens percentage, and gross profit is expected to be up by positive low single digits, and adjusted EBITDA margin is expected to be negative low to mid single digits. In other words, the Cash App renewal is putting pressure on both the bottom and top line of the business, and there's going to be a lot of changes in terms of financial reporting, and this is going to create a lot of uncertainty in terms of the margin and growth profile of the business. But that aside, Marqeta is seeing massive traction in bookings, which should support overall business growth. In particular, bookings for the last 3 quarters grew 150% compared to the same period a year ago, with a 50-50 split between net new customers and expansion deals with existing customers. In addition, Q2 bookings grew 60% from the prior quarter, driven by embedded finance, and 1/3 of the deals were so-called flip deals, where Marqeta replaces an incumbent provider. And this is important because it means that customers are migrating to Marqeta's platforms, which is great to hear. With that being said, despite the changes in financial reporting, the outlook for Marqeta still looks great as the company continues to disrupt the issuing facing side of the payment ecosystem, as well as capture the fast-growing embedded finance market. However, with all these moving parts and changes in their financials, I'm not sure how the markets will re-rate Marqeta stock, and that creates uncertainty risk in terms of valuation, which is what I'm going to discuss next. If we look at Marqeta's price action, we can see that Marqeta stock is still down 80% from its all-time highs, and this is probably due to high interest rates, management changes, and block contract expiration, which I think is the biggest factor for the negative sentiment on the stock. But with the Cash App renewal in place, sentiment has changed to positive, as you can see by the 10-20% pop in the stock after the deal was announced. And now the stock price is finally trading above the 200-day simple moving average, which is the orange line right here, which means that the primary trend has shifted to the upside. So despite having rallied more than 60% from its bottom, I think there's more upside for Marqeta stock given the change in sentiment and price trend, especially if the stock price break through the $6 resistance right here. So it'll be very interesting to see the price action in the next few weeks or so. But moving on, in terms of valuation, Marqeta trades at an EV to revenue multiple of just 2 times, which is way lower than its highs of 48.8 times and its average of 10.6 times. So by historical standards, Marqeta is trading very cheaply. I've done a DCF analysis on Marqeta as well, and in my previous video, I valued Marqeta at about $9.52. So I've updated my model, but keep in mind that this is a very challenging exercise given all the changes due to the Cash App renewal. But with that being said, here is my updated model and here are my key assumptions. As always, for the first 3 years, I will follow analyst estimates for revenue growth. Analysts expect revenue to decline by 13.1% for 2023 as the new Cash App contract kicks in, which is also in line with management's expectation of a low teens percentage decline. In the next year, analysts also expect revenue to contract by 9.3% as the company continues to experience revenue headwinds from the Cash App renewal. But by 2025, the Cash App renewal would have been fully lapped, which is why analysts expect Marqeta to return to growth mode, growing at just 1.9% in 2025. And moving forward, I expect growth to re-accelerate to 20% in 2026 and then gradually slow down to just 12% by 2032. There's not much visibility on the gross margin profile of the business just yet, but management did mention that Q3 gross margin will be in the low 70s and improve by 3 to 4 points in Q4. That means Marqeta will have a gross margin profile of about 75%, but to be conservative, I'm projecting a gross margin profile, a long-term gross margin profile of just 73% by 2032. And for the rest of the assumptions, I will set them in such a way that the company gains operating leverage and improve free cash flow year by year, eventually reaching a free cash flow margin of about 25%, as you can see right here. And for context, Visa, MasterCard, and PayPal has free cash flow margins of 61%, 45%, and 19% respectively. So free cash flow flow margin of 25% for Marqeta is quite reasonable in my opinion. And using a discount rate of 12% and a perpetual growth rate of 2.5%, I arrive at a fair value estimate of $7.15 for Marqeta, which is slightly higher than the average price target of $6.64 set by analysts. And based on the current price of $5.72, I see a potential upside of about 25% for Marqeta stock. This updated price target is actually lower than my previous target of $9.52, and this reflects the high uncertainty and somewhat negative impact the Cash App renewal have on the fundamentals of the business. So because of this, I have lower conviction on the stock, and that is why I'm reducing my price target. In addition, I'm not sure how the markets will react when Q3 results come out, when the headline says Marqeta's revenue plunges by 50%. I think there's going to be a lot of panic selling, and for that reason, I'm considering trimming my position in Marqeta heading into Q3 results. Whatever it is, I think there's a potential catalyst that could drive the stock higher, which is Block acquiring Marqeta. Here are some good reasons why that can happen. First, I think the recent Cash App renewal speaks for itself, that Block still wants to work with Marqeta, which is key. Second, Block accounts for more than half of Marqeta's revenue, so it makes a lot of sense for Marqeta to sell itself to its largest customer. Thirdly, Marqeta and Block have been working together for almost a decade, I think for about 7 years, so there's strong proof of concept and product market fit. Fourth, Marqeta powers Block's most important products, namely Cash App, Square Card, and Afterpay. Fifth, the fintech space is increasingly getting more competitive, and consolidation between two high-quality companies could be the right move to strengthen competitive positioning. Sixth, Marqeta is certified to operate in more than 40 countries, which enables Block to expand globally quickly. Seventh, insiders are buying shares. Just recently, two directors bought a combined $1.4 million worth of Marqeta stock. Finally, in its 10Q filing, Marqeta disclosed the Cash App renewal, which also included an unusual statement, which said the amendment also includes a continuation of services for the Cash App program for a period of time in the event of a change of control of the company. To me, that's really unusual for the company to include that statement, which raises speculation that the company intends to be acquired by another company. That said, if Marqeta does get acquired, we could see the stock go up and get an acquisition premium. Quickly turning to the risks, the first major risk with investing in Marqeta is of course concentration. In Q2, Marqeta generated 78% of its revenue from Block, and although Block revenue concentration is likely to drop following the Cash App renewal, Block's concentration will remain more than 50% of revenue, which is still very significant. And if Block faces its own company-specific challenges, Marqeta will be dragged down as well. The next risk is fundamental uncertainty. As mentioned earlier, due to the Cash App renewal and the reduction in pricing, the fundamentals of the business are looking cloudy with no real visibility as to what the long-term margin profile and pricing power of the business look like. And this fundamental uncertainty decreases my conviction in Marqeta stock. Finally, while Marqeta is the first modern card issuing platform, the company still faces tough competition from legacy processors like Fiserv, other fintech companies like Stripe and SoFi, which can take market share away from Marqeta. So here's my thoughts on Marqeta. Q2 was a breakthrough quarter for Marqeta as the company finally extended its partnership with its largest customer, Block, which eliminates the risk of a major customer leaving the platform. However, fundamental uncertainty arises with the new deal, particularly with how pricing and financial reporting are structured, which is probably the only thing that reduces my conviction on the stock. Nevertheless, Marqeta still has a long growth runway ahead as the company disrupts the issuing-facing side of the payment ecosystem and captures the fast-growing embedded finance market. In addition, the stock remains undervalued with decent upside. As for me, my plan is to continue to hold Marqeta stock because Marqeta is the best modern issuer processor, the stock looks undervalued, and the company looks like a prime acquisition target. However, I do plan to trim my position heading into Q3 results. With that being said, what are your thoughts on Marqeta stock and the newly extended partnership with Block? Please let me know in the comment section down below. Otherwise, that's all that I have for you today. If you find value in this video, please leave a like, comment, and subscribe to my channel for more investment content. As always, I appreciate you and I hope you have an amazing day. See you guys on the next video.